The financial world has been buzzing with anticipation as economists and experts predict a looming recession in 2024. In the midst of this uncertainty, one name continues to stand out: Michael Burry, the man who famously predicted the housing bubble and the ensuing financial crisis of 2008, is back in the spotlight with his predictions for the next economic downturn. Burry's insights have made him a household name in the world of finance, and his advice is highly sought after. In this article, we will delve into Michael Burry's 8 strategies for navigating the 2024 recession and building wealth in these challenging times. 1. Understand the economic landscape. Michael Burry's first piece of advice is to thoroughly understand the economic landscape. In order to make informed decisions during a recession, it is crucial to grasp the underlying factors driving the downturn. Burry suggests studying economic indicators, analyzing historical data, and keeping a close eye on global economic trends. By gaining a deep understanding of the economic environment, you can identify potential opportunities and threats and make informed investment choices. Burry emphasizes the importance of studying economic indicators as a means of gaining insight into the state of the economy. These indicators can include GDP growth rates, unemployment figures, inflation rates, and consumer confidence indices. By tracking these metrics, investors can identify trends and shifts that may signal an impending recession. Additionally, historical data can provide valuable context, allowing you to see how previous recessions unfolded and what strategies were effective during those times. Moreover, it's essential to monitor global economic trends and geopolitical events that could impact the economy. In our interconnected world, events in one country can have far-reaching consequences affecting markets and industries worldwide. Keeping abreast of developments in major economies, trade agreements, and geopolitical tensions can help you anticipate potential risks and opportunities. 2. Diversify your portfolio. One of the most fundamental principles of investing that Burry advocates is diversification. Diversifying your investment portfolio involves spreading your investments across different asset classes such as stocks, bonds, real estate, and commodities. This strategy helps mitigate risk because when one asset class performs poorly, another may perform well, balancing out your overall returns. Diversification is a key strategy for protecting your wealth during a recession and ensuring that you don't put all your eggs in one basket. 3. Invest in safe havens. During times of economic uncertainty, certain assets tend to perform better than others. Michael Burry advises investors to consider allocating a portion of their portfolio to safe haven assets. Safe havens are investments that are traditionally less susceptible to economic downturns. These may include precious metals like gold, high-quality bonds, and defensive stocks in sectors such as healthcare and utilities. These assets can provide stability and act as a hedge against the volatility of the stock market. 4. Be patient and stay the course. In turbulent economic times, it's easy to panic and make impulsive investment decisions. Burry stresses the importance of staying patient and maintaining a long-term perspective. Recessions are often followed by periods of recovery and growth, and selling investments in a panic can lead to significant losses. By holding on to your investments and riding out the storm, you are more likely to benefit from the eventual market rebound. 5. Analyze individual stocks. Michael Burry is known for his deep dive into individual stocks. He believes in the importance of conducting thorough research and analysis of individual companies before investing in their stock. This approach, known as fundamental analysis, involves evaluating a company's financial health, management team, competitive position, and growth prospects. By carefully selecting individual stocks with strong fundamentals, you can potentially outperform the broader market even in a recession. 6. Consider shorting weak stocks. While it may not be suitable for all investors, Burry gained fame for his successful bets against the housing market in the mid-2000s. Shorting involves borrowing shares of a stock and selling them with the expectation that the stock's price will decline. If the price does fall, you can buy the shares back at a lower price and profit from the difference. Burry suggests identifying companies with weak financials or unsustainable business models and consider shorting their stocks. However, It's important to note that shorting can be risky, and losses can be substantial if the stock price rises. To effectively short stocks, you need to identify companies that are likely to underperform or face financial challenges during a recession. Look for businesses with high levels of debt, weak profitability, or unsustainable business models. Companies in sectors particularly vulnerable to economic downturns, such as retail or hospitality, may be prime candidates for shorting. Just as with long-term investments, shorting requires thorough research. Analyze a company's financial statements, management team, competitive position, and growth prospects. Assess the likelihood of negative catalysts that could drive its stock price down, such as declining sales, increased competition, or regulatory issues. 7. Build an emergency fund. During a recession, job security can become uncertain, and unexpected expenses may arise. Burry advises individuals to build an emergency fund to provide a financial safety net. An emergency fund typically consists of 3 to 6 months' worth of living expenses held in a liquid, easily accessible account. Having this cushion can help you weather financial storms without having to dip into your long-term investments or go into debt. Without an emergency fund, individuals often turn to credit cards or loans to cover unexpected costs. High-interest debt can quickly become burdensome, making it harder to recover financially when the recession subsides. By having a fund in place, you can avoid the pitfalls of unnecessary debt. Knowing you have a financial cushion can alleviate stress during uncertain times. This peace of mind can enable you to make more rational financial decisions and maintain your emotional well-being, even when economic conditions are challenging. 8. Seek professional guidance. Finally, Michael Burry recommends seeking professional financial advice, especially during times of economic uncertainty. Financial advisors can help you navigate the complexities of the market, create a tailored investment strategy, and provide guidance on risk management. Working with a trusted advisor can give you confidence in your financial decisions and help you stay on track towards your wealth-building goals. Navigating a recession requires careful risk management. Professional advisors are well-versed in risk assessment and can help you make prudent decisions about asset allocation and investment choices. They can guide you in adjusting your portfolio to minimize potential losses and seize opportunities that arise during economic downturns. Financial advisors have access to a wealth of market research and analysis. They can provide you with up-to-date information on market trends, economic indicators, and investment opportunities. This insight can be invaluable in making informed decisions in a rapidly changing financial landscape. One of the challenges investors face during recessions is the emotional aspect of investing. Fear and panic can lead to impulsive decisions that harm your financial prospects. A financial advisor can offer behavioral guidance, helping you stay disciplined and stick to your long-term investment plan, even in turbulent times. Tax planning is another area where professional guidance can yield significant benefits. Financial advisors can help you optimize your investment strategies to minimize tax liabilities, potentially preserving more of your wealth in the long run. Conclusion: as the specter of a recession looms on the horizon, Michael Burry's sage advice offers a roadmap for investors looking to safeguard their wealth and potentially profit in these challenging times. Understanding the economic landscape, diversifying your portfolio, and investing in safe havens are foundational strategies for recession-proofing your finances. Additionally, taking a patient, long-term approach and conducting thorough analysis of individual stocks can help you thrive in the face of adversity. While Burry's strategies can be valuable, it's essential to remember that no investment is entirely risk-free and individual circumstances vary. Building an emergency fund and seeking professional guidance are crucial elements of a well-rounded financial strategy. By carefully considering these 8 tips from Michael Burry, you can better position yourself to navigate the 2024 recession and work towards your financial goals with confidence. Thank you for sticking with me all the way to the end. Please like, comment, and subscribe, and make sure the notification bell is turned on so you don't miss a video.